Disclaimer.
AG here, and I've got a question for you. What do New Year's Eve and a 9% silver crash have in common? Turns out, everything. December 30th, 2025 started like any other trading day for silver investors who had watched their holdings climb 166% over the year. By lunchtime in New York, everything changed. Silver crashed 8.7% in a matter of hours, plummeting from its record high of 86.62 per ounce down to 72, the single largest one-day collapse since February 2021. If you owned silver that morning, you watched thousands of dollars evaporate from your portfolio before you finished your afternoon coffee. Here's what should grab our attention. This wasn't some breaking news event. No war broke out, no factory exploded, no central bank made a shocking announcement. The fundamentals that drove silver to record highs just 48 hours earlier hadn't changed at all. Industrial demand remained strong, supply deficits persisted, inflation concerns continued. Yet somehow the best performing major commodity of 2025 just shed nearly 9% of its value in a single session. Wall Street analysts scrambled to explain it as normal volatility or profit-taking after a monster year, but if you've been paying attention to what's happening behind the scenes in global banking, you know this crash had nothing to do with market forces and everything to do with a calendar date that 29 of the world's largest banks have been dreading all year long. Let me walk you through what really happened on December 30th, because understanding this mechanism is the key to everything that is about to unfold in the silver market over the next few months. The crash wasn't random, it was required. Under Basel III banking regulations that fully took effect on July 1st, 2025, the world's systemically important banks face massive penalty calculations based on their balance sheet size on one specific day each year, December 31st. Think of it as the ultimate financial report card, except instead of getting graded on what you accomplish, you get penalized for how big you are. The larger your balance sheet on that snapshot date, the more capital you must hold in reserve, and the more regulatory fees you pay. According to research published by the European Central Bank, banks reduced their repo market volumes by up to 25% at year-end specifically to game these calculations. This isn't speculation or conspiracy theory. It's documented regulatory gaming that happens every single December. And it happens because the penalties for being too large on December 31st can cost banks billions of dollars in additional capital requirements. Now here's where silver enters the picture and where most investors miss what's actually happening. Basel III didn't just change capital requirements, it fundamentally reclassified what counts as a safe asset on bank balance sheets. Gold got promoted. It's now recognized as a Tier 1 asset valued at 100% of its market price, putting it in the same category as cash and government bonds. For the first time in modern banking history, gold officially counts as money in the eyes of global financial regulators. Silver got the opposite treatment. Paper silver, the derivative contracts and futures positions that make up the majority of silver trading, became toxic for banks to hold under the new rules. The leverage limits tightened dramatically. The capital charges increased. And most importantly, banks now face a brutal choice. Either own physical silver that you can actually touch and store, or exit your silver positions entirely because the cost of holding paper silver on your balance sheet just became prohibitively expensive. This created what insiders call a 300-to-1 leverage crisis. For every physical ounce of silver that actually exists in Comex warehouses, there are roughly 300 paper claims on that same ounce floating around the financial system. Think about that for a moment. If you own a silver ETF or a futures contract, you're sharing your claim on physical metal with 299 other investors who think they own the same ounce you do. Basel III just forced banks to confront this reality, and what happened in late 2025 should terrify anyone who thinks the paper silver market accurately represents true supply and demand. According to Comex delivery data, 60% of all registered silver inventory was claimed for physical delivery in just 4 trading days in late December. 4 days. More than half the available silver in the world's largest precious metals exchange walked out the door as institutions scrambled to convert their paper promises into actual metal before the regulatory hammer fell. So when December 30th arrived, the last trading day before the December 31st snapshot, the 29 global systemically important banks faced a mathematical problem they couldn't ignore. Their balance sheets were too large, their exposure to derivative positions was too high, and the penalties for staying that large would cost them billions in additional capital requirements throughout 2026. The solution was brutally simple. Sell everything that isn't nailed down before midnight on December 31st, then buy it all back on January 2nd when the snapshot is over and the penalties reset. This is exactly what happened to silver on December 30th. The crash you saw wasn't investors losing faith. It wasn't fundamentals deteriorating. It was the world's largest banks executing a coordinated balance sheet reduction to avoid regulatory penalties. And silver became collateral damage because paper silver positions are easy to dump quickly in massive volume without actually owning any physical metal. Pop quiz. What happens to an asset's price when the forced selling pressure that drove it down 8.7% in one day suddenly vanishes? What happens when the same banks that had to shrink their balance sheets on December 31st no longer face any regulatory pressure to stay small on January 2nd? What happens when pension funds managing $38 trillion in assets start their new year by rebalancing into the best performing commodity of 2025, right when banks stop their artificial selling? You're watching the setup for one of the most predictable price reversals in modern financial history. Except this time, there is a complication that makes January 2026 completely different from every previous year-end banking squeeze. The physical metal is disappearing. Not slowly, not gradually, rapidly and measurably. Comex registered inventories and the silver that is actually available for delivery to investors have collapsed 70% since 2020. We're talking about a drop from 346 million ounces down to just 82 million ounces today. At the same time, open interest for January 2026 delivery hit the highest level in history for any minor delivery month. Institutions aren't just buying silver, they're demanding physical delivery, converting their paper claims into metal they can hold, because sophisticated investors understand what's coming. For the first time in decades, silver hit backwardation, a technical condition where spot prices trade above futures prices. In normal markets, futures cost more than spot because you're paying for the privilege of delivery later. When that relationship inverts, it signals desperate physical demand. It means people would rather pay more for silver today than wait for delivery tomorrow because they're genuinely worried that tomorrow's delivery might not come. The December 31st snapshot creates a 24-hour window where banks are legally required to show smaller balance sheets, forcing them into artificial selling that has nothing to do with silver's actual value or market fundamentals. But midnight on December 31st doesn't just end the calendar year. It ends the regulatory pressure. It ends the forced selling. And it unleashes the exact opposite dynamic on January 2nd, when fresh capital floods into the market right when banks no longer need to suppress their positions. What makes this year different from every previous December is that the physical silver backing these paper markets is running out at the exact moment when regulatory pressure forces banks to either own real metal or exit entirely. The accounting trick that crashed silver by 8.7% on December 30th worked because paper markets still dominate price discovery. But when the calendar flips to 2026 and institutional buyers start demanding physical delivery into a market that just lost 60% of its registered inventory in 4 days, the window dressing games end and the supply crisis begins. You're watching the last act of a system that's been running on leverage and paper promises for decades. And the curtain drops at midnight on December 31st, 2025. Let me show you exactly why this is not just another market fluctuation that will blow over in a few weeks. The evidence isn't hidden in some conspiracy forum or whispered by anonymous sources. It's sitting in official exchange data, central bank reports, and warehouse inventories that anyone can verify. And what these numbers reveal should fundamentally change how you think about silver's future. Start with the Comex warehouses in New York, because this is where the paper silver market claims to have physical backing for all those derivative contracts. According to official Comex data, registered inventories have collapsed from 346 million ounces in 2020 to just 82 million ounces today. Now that is a 70% decline in the actual silver available for delivery to investors who want to convert their paper claims into metal. Think about what that number really means for a moment. Imagine you have a bank account showing a balance of $10,000, but when you try to withdraw your money, the bank tells you they only have $3,000 left in the vault because 7 other people already withdrew their shares. You'd call that a bank run. You'd call that insolvency. But in the silver market, we just call it Tuesday and keep trading as if nothing's wrong. Here's where it gets interesting. For the first time in decades, silver hit backwardation, a technical term that sounds complicated but reveals something profoundly simple about physical demand. In normal commodity markets, futures contracts cost more than spot prices because you're paying a premium for guaranteed delivery later. You pay extra for the convenience of not having to store the metal yourself, not having to worry about security, not having to deal with logistics. When that relationship inverts and spot prices trade above futures, it means people are willing to pay more for silver today than for guaranteed delivery tomorrow. According to the London Bullion Market Association, this pricing anomaly signals one thing above all else: desperate physical demand from buyers who genuinely fear that tomorrow's delivery might not happen. The January 2026 delivery month just recorded the highest open interest in history for any minor delivery month on Comex. Minor months aren't supposed to see heavy activity because most institutional trading concentrates in March, May, July, September, and December. But January 2026 broke all the records because sophisticated investors watched what happened in late 2025 and decided they'd rather take delivery now than risk waiting. Let me put this in perspective with some specific numbers that should make you uncomfortable. During those 4 trading days in late December, when 60% of registered inventory got claimed for delivery, we're talking about roughly 49 million ounces walking out of Comex warehouses in less than a week. The entire global silver mining industry produces about 830 million ounces per year, which means those 4 days represented nearly 6% of annual global production leaving the exchange that's supposed to be setting prices for the entire world market. Now, let's talk about what happens on January 1st, 2026, because while American banks are gaming their December 31st balance sheet snapshots, China is implementing export restrictions that fundamentally reshape global silver supply chains. The new Chinese regulations require exporters to maintain minimum capacity of 80 tons and obtain state-issued licenses before shipping silver out of the country. According to analysis from Metals Focus, this will immediately block hundreds of mid-sized exporters who currently supply global markets but can't meet the new threshold requirements. China doesn't produce the most silver in the world. Mexico and Peru lead in mine production, but China controls critical refining capacity and serves as a major hub for recycled silver flowing into international markets. When those hundreds of mid-sized exporters get shut out on January 1st, the global supply chain doesn't just slow down, it fractures. The silver they would have shipped to London, New York, or Zurich simply stays in China, either for domestic industrial use or as strategic stockpiling. Either way, it's not available to meet the growing physical demand in Western markets where pension funds and institutional investors are just starting to rebalance into 2025's best performing asset. This happens right when we're already facing what the Silver Institute calls a cumulative supply deficit of 800 million ounces over the past 5 years. 800 million ounces. That's equivalent to 1 full year of total global silver production that's already been consumed by industrial users, investors, and jewelers without being replaced by new mining or recycling. Physical evidence of this deficit shows up in warehouse data that's updated daily. London vaults have drawn down 40% of their silver inventories over the past 2 years. Shanghai inventories have fallen to decade lows. According to the Shanghai Futures Exchange, registered silver stocks dropped below 300 tons in late 2025, the lowest level since 2015, while import premiums spiked to multi-year highs as Chinese buyers scrambled to secure physical metal before the export restrictions kicked in. You might be wondering why banks can't just magic more silver into existence if demand is this strong. Here's where we need to talk about what Basel III actually did to the silver market, because most coverage completely misses the real mechanism at work. The Basel III loophole that everyone talks about isn't about what banks can do with silver. It's about what they cannot do anymore. Research published by the Bank for International Settlements confirms that global, systemically important banks reduce their balance sheet exposure by up to 25% before year-end reporting dates, specifically to game their capital requirement calculations. This isn't a controversial claim. The BIS literally studied this behavior and published their findings. But here's what makes 2025 different from every previous year. In the past, banks could hold massive paper silver positions without much regulatory penalty because derivatives counted as relatively low-risk assets on their balance sheets. Basel III changed that calculation completely by reclassifying precious metals exposure and tightening leverage limits on derivative positions. Now banks face a binary choice: own physical silver that you store in allocated vaults, and can prove you possess or exit your silver positions entirely because the capital charges for holding paper, silver, just became prohibitively expensive. There's no middle ground anymore. There's no, we'll just roll these futures contracts and deal with it later option. You either have the metal or you don't, and if you don't, Basel III treats your position as a high-risk liability that requires substantial capital reserves. This forces the 300-to-1 leverage crisis I mentioned earlier into the open. When 300 paper claims exist for every physical ounce, and when regulations suddenly require banks to actually own the physical metal backing, those claims, simple math tells you that 289 out of every 300 claimants are going to be disappointed. They're going to get cash settled instead of physical delivery. They're going to discover their silver investment was really just a bet on price movements, not ownership of actual metal. The window dressing that crashed silver on December 30th worked because banks could quickly dump their paper positions without touching physical metal. They sold futures contracts. They exited ETF exposure. They closed out derivative positions. All of it happened on computer screens and cleared through electronic systems, moving billions of dollars in notional value without a single physical ounce changing hands. But that selling pressure evaporates at midnight on December 31st, when the snapshot ends and regulatory penalties reset for the new year. Starting January 2nd, banks no longer face artificial pressure to shrink their balance sheets. Meanwhile, pension funds managing $38 trillion in assets and insurance companies controlling another $8 trillion begin their annual rebalancing process, and they're looking at silver's 166% return in 2025 with serious interest. According to data from the Investment Company Institute, pension funds typically rebalance in early January to take profits from winners and redeploy into undervalued opportunities. But when the asset that just delivered a 166% return is simultaneously experiencing a supply crisis, the normal playbook stops working. Taking profits from silver makes sense in a normal market. Taking profits from an asset where physical inventories are vanishing and industrial users are fighting investors for every available ounce is a very different calculation. Here's what should keep you up at night. With only 82 million ounces of registered silver left in Comex warehouses and industrial demand requiring 1.224 billion ounces annually, we are looking at roughly 30 to 45 days of physical reserves remaining in the exchange that's supposed to be the global price-setting mechanism for silver. 30 to 45 days. That's not a comfortable buffer. That's not a strategic reserve. That's the amount of inventory you'd expect to see right before a system breaks. When institutional investors start converting their $430 billion in potential allocations to hard assets, they're not going to politely wait in line while Comex figures out where to find more physical metal. They're going to demand immediate delivery, exercise their contract rights, and force the exchange to either produce the silver or admit they can't. The Bank for International Settlements doesn't publish recommendations on window dressing because they think it's good practice. They publish warnings because they have seen what happens when banks game regulatory snapshots at the exact moment when underlying markets face genuine supply constraints. The December 31st accounting trick ends precisely when the supply crisis accelerates, and nobody in the official sector has a plan for what happens when forced selling flips to institutional buying, while warehouse inventories continue their relentless decline. You're not watching a normal market cycle where prices go up and down based on economic data and investor sentiment. You're watching a structural break happening in real time, documented in official exchange data, confirmed by central bank research, and accelerating toward a convergence point that arrives in less than 48 hours. January 2nd, 2026 isn't just another trading day. It's the exact moment when three separate forces converge on the silver market simultaneously, creating a mathematical pressure point that the current pricing system simply cannot absorb without breaking. Let me walk you through what happens hour by hour, because understanding this timeline is critical to grasping why the next few weeks will likely determine silver's trajectory for the entire year ahead. At midnight on December 31st, the GSIB snapshot ends. The regulatory pressure that forced banks to shrink their balance sheets by 25% vanishes instantly. Banks that dumped silver positions on December 30th to avoid billions in penalties no longer face any regulatory incentive to stay small. The window dressing is over. The balance sheet games reset for a new annual cycle. 8 hours later, when Asian markets open on January 1st, China's new export restrictions activate. Hundreds of mid-sized exporters who have been shipping silver to global markets for years suddenly find themselves locked out, unable to meet the 80-ton minimum capacity requirements or obtain the necessary state licenses. According to Metals Focus, these restrictions will immediately reduce available global supply by an estimated 15-20% as Chinese silver that would have flowed to London and New York stays domestic instead. Then January 2nd arrives, and pension funds managing $38 trillion in assets, plus insurance companies controlling another $8 trillion, begin their annual rebalancing into the best performing commodity of 2025. If just 1% of that combined $46 trillion shifts allocation towards silver, we're talking about $460 billion in potential buying pressure hitting a market where total annual supply is only worth $30 to $35 billion at current prices. Think about that math for a moment. The entire global silver market, all the mining, all the recycling, all the warehouse inventory, produces roughly $30 billion worth of silver each year at recent prices. 1% of pension and insurance rebalancing equals $460 billion. That's 15 times larger than total supply. Even if only a fraction of that capital actually deploys, even if most pension funds stick with traditional allocations, the mismatch between available metal and institutional demand creates a price discovery crisis that Comex has never experienced before. Here's where the math gets really uncomfortable for anyone managing silver futures contracts. With industrial users needing 1.24 billion ounces annually, but total supply, including recycling, delivering only 1.01 billion ounces, we're running a structural deficit of 230 million ounces every single year. That's not a temporary imbalance that resolves itself when prices rise. That's a permanent supply shortage because 75-80% of silver production comes as a byproduct of copper and zinc mining operations that don't respond to silver prices at all. When copper mines produce ore, they get silver whether they want it or not. When zinc refineries process concentrates, silver shows up in the output stream. These mines don't increase production because silver hits 100 per ounce. They increase production when copper or zinc prices justify expanding operations, and silver just comes along for the ride. According to the Silver Institute, this byproduct dynamic means silver supply is fundamentally inelastic to price changes, creating a situation where rising prices don't automatically bring more supply to market like they would in most commodity sectors. UBS released their 2026 commodity outlook projecting silver prices between $55 and $65 per ounce based on industrial demand and supply constraints alone, without factoring in any investment flows or monetary demand. Goldman Sachs put out research targeting gold at $4,500 per ounce for 2026. And if you apply the historical gold to silver ratio of 45 to 1, that implies silver should trade around $100 per ounce just to maintain normal relationships with gold. But here's what neither of those projections accounts for: what happens when the paper market decouples from physical reality entirely. We've seen this movie before in other commodity markets. Lithium experienced exactly this breakdown when electric vehicle demand exploded, while supply chains couldn't respond fast enough. Spot lithium traded at massive premiums to futures contracts because buyers needed physical delivery immediately and weren't willing to wait for contracts to settle months later. Rare earth elements went through the same decoupling when China restricted exports in 2010. Futures markets became essentially meaningless because the only price that mattered was what you had to pay to actually get physical metal delivered to your facility today, not what some contract promised you might pay 6 months from now. Silver is setting up for that exact same dynamic, except this time it's happening in a market that's 50 times larger and far more critical to global industrial supply chains. When Comex futures decouple from physical spot prices because registered inventories can't meet delivery demands, $100 per ounce stops being a speculative target and starts being the floor price for anyone who actually needs physical metal. Let me show you what this means for our economy and our daily lives, because this isn't just about traders making money or losing money on commodity bets. Solar panel manufacturers need 130 million ounces of silver annually to meet global renewable energy goals. Electric vehicle producers require 25 to 30 million ounces for the electronics and components in every million vehicles they build. Medical device companies depend on silver's antimicrobial properties for everything from wound dressings to surgical instruments. When those industrial users can't source silver at any reasonable price, they don't just shrug and move on. They halt production lines, they delay product launches, they pass costs through to consumers who are already dealing with inflation in nearly every other category of goods and services. The January 2nd convergence creates a specific window that you need to understand if you're trying to navigate this market intelligently. The forced selling from December 30th reversed immediately when calendar pressure ended, but the real buying pressure from institutions deploying fresh capital into their best 2025 performer won't hit full force until mid-January when quarterly rebalancing completes. That gives you roughly 2 weeks to position before the full weight of institutional flows enters the market. What makes this timeline critical is that physical availability is declining every single day. According to Comex warehouse reports updated daily, registered inventories continue dropping as investors take delivery and convert paper claims to metal. We're not talking about gradual declines over months. We're seeing warehouse stocks fall by millions of ounces per week as the smart money exits paper markets entirely and demands physical possession. When Scotiabank exited the precious metals clearing business entirely in 2025, they weren't making a casual business decision. They were acknowledging what every major clearing bank understands: the liability of promising physical delivery on hundreds of millions of ounces of silver that may not actually exist in available form is becoming too large to manage. Scotia saw the same warehouse data you can see. They ran the same math on registered inventory versus open interest. And they decided the risk of being unable to deliver on their clearing obligations outweighed any profit from staying in the business. The final warning I need to give you isn't about price volatility. Markets go up and down. Commodities swing wildly on sentiment and speculation. That's normal and expected, and something any investor should be comfortable handling. The warning is about availability. When Comex officials quietly implemented 50% eligible inventory restrictions in 2021, they were preparing for exactly the scenario we're entering now: a vault drain emergency where demand for physical delivery exceeds available supply, and the exchange faces the choice of either defaulting on contracts or fundamentally changing how the market operates. Think about what that means in practical terms. You might see silver quoted at 75 per ounce on your screen, while simultaneously being unable to actually buy physical metal for less than $95 because the premium for delivery has spiked to $20 over spot. You might watch futures contracts trade at $80 while coin dealers are completely sold out and refineries have 8-week backlogs for new production. This is the world we're entering on January 2nd, when regulatory pressure to sell disappears, Chinese export restrictions activate, and institutional capital starts hunting for the best performing asset of 2025, right when physical inventories are at their lowest levels in decades. The 2026 timeline matters because this may genuinely be the last year when silver trades anywhere near three-digit prices before industrial allocation rationing begins. When solar manufacturers and electronics companies start competing directly with investment demand for every available ounce, and when that competition happens against a backdrop of 230 million ounce annual deficits that mining can't resolve because production is locked to base metal. Economics, the market structure we've relied on for decades, simply stops functioning. You're watching the final act of a system built on paper promises and fractional reserves, trying to survive contact with physical reality and mathematical certainty. The December 30th crash was banks playing their last card, manipulating prices through regulatory window dressing to avoid penalties. But midnight on December 31st took that card off the table permanently for 2026, and everything that happens from January 2nd forward is pure supply and demand physics. The convergence is here. The math is clear. And the question isn't whether the current pricing system can survive this pressure. It's whether you understand what is happening well enough to position yourself on the right side of the structural break before the window closes entirely.